Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, once again with John Teixeira, and back this week with us for another mortgage rate, mortgage update,
An update
all
on the
those
chaos.
things. Trever Kerr with Gateway.
How are you guys?
If you guys have any questions about mortgage rates or want another update over the phone because you didn't want to listen to this whole episode, give us a call, 817-818-9039, or shoot us an email at showmethemoney@wearetpm.com. What is the date today, Trevor and John? We're going to give people an update. It's
August 14th?
because in this environment, that could change by tomorrow,
2024?
right?
Oh, yeah.
So August 13th of 2024.
August 13th.
Let's give everybody a little update on the market and how everything's going.
You're right. It could change hour by hour here, and it has been here lately. You know, the big thing is out there that a lot of people, are calling about. Oh, we just saw mortgage rates have fallen lowest levels, in the last year, last year and a half, and that was true, and that lasted for one day.
Yeah, for like a day.
That lasted for one day, and then rates actually jump back up higher than they have been over the last month or so, and they're starting to come back down again. Bottom line is interest rates, depending on what type of loan program you're looking at, interest rates are about mid-sixes right now, okay? And, right around 6.5%. A lot of people say, well, I see this at, 6%, why can't I get 6%? You can if you're looking at government loan products.
Yeah.
Government loan products right now are about 0.75% lower than what conventional loan products are. So
when you say that, you mean FHA and VA, right?
yeah, FHA and VA.
Just
and
primarily for people's primary residence and not really for
Exactly.
investment
Yeah,
property.
not for investment properties and stuff. You start talking about investment properties and stuff, you're not going to see a rate in the sixes, for investment properties. They're going to be in the sevens. But, that's why a lot of, information that a lot of people put out there, lowest rates you've seen in the year and stuff. So you start having all these calls flood in. Hey, is it time to refinance? Well, let's look at your situation, but chances are probably not.
Yeah.
But
Did you refinance back in 2021 at a 3%? Yeah, not the time. So, and I know we've gotten calls, so let's ask John over here. How's that affect people's mindset for listing their house?
Well, it's funny. I was just sitting here thinking about what Trevor was saying, and this I kind of hopefully answer your question, Kyle, that people get their news in tidbits, right? They get their news nowadays in little bits of pieces of information, right? And sometimes it's a good thing because they're not overwhelmed by it, but sometimes, like for instance, everyone thinks that the rate that you're going to get today is solely tied to what the Fed says or does, right? And that does have an impact on what the interest rate is. But to your point, you were just making, Trevor, things changing hour by hour, other things are affecting that interest rate as well, right? The market conditions. Let's talk a little bit about that. What else is affecting the interest rate?
So the interest rate and stuff, and a lot, it's not solely goes by this all the time, but kind of a good rule of thumb is if the stock market's doing really good, the people, these huge investors that have billions of dollars and stuff and invest, they pull their money out of the MBS market, which is the mortgage-backed security market, put it over into the stock market. When the stock market, when they do that, it causes rates to go up, okay? When the stock market starts doing poorly and starts coming down, they pull those billions of dollars out of the stock market, move it over to the MBS market, which causes our rates to go down. That's kind of a general rule of thumb of kind of what happens and
So
and
when the
what
stock market
fluctuates
goes
that.
down 10% in 3 days, that's them moving all their money into MBSs.
That's correct. Yep.
Yeah, it's got to go somewhere, right? So,
Yeah.
and that,
Yeah, they're not pulling it out and sticking it in their mattress or
yeah. And that lined up last week with the mortgage rates going down.
That's
so
correct.
that's why, and everyone seemed to have heard about that. So.
yeah, it is, Like John was saying, everybody kind of gets their news in tidbits, which is a good thing, It never hurts to call someone and find out what's really going on, which did spur a lot of phone calls and stuff, hey, rates are going down. Heard that. Is it time to do something? Well,
Maybe.
maybe it would be, but in most cases it wasn't the right time for everybody right now. But
Well, and
overall, the market rates are better than they have been over the last 6 months and stuff. So rates are coming down a little bit, and I think will continue to slowly come down. It's not going to all of a sudden wake up tomorrow and rates are going to be 5% or 4.5%.
But at the beginning of summer, we were talking, and I was like, "Can we even get under 8 in these primary residents?" And your answer wasn't for sure. So it wasn't.
No.
Yeah, if you have really good credit, maybe. So I mean, and this all does tie somewhat to the Federal Reserve rate, which hasn't even changed yet.
That's
right?
correct.
So I mean, these things follow expectations of the Fed rate a little bit, but we may not even see our first change in the rate in the last 2 years till September, maybe.
Yeah,
if we trust our Fed.
We're starting to see signs. Inflation is slowing down tremendously. Is actually a little bit under what forecasts are. So if it continues that track, the Fed will lower that rate.
Yeah, I know they're in their actual target range, which is impressive. It's the unemployment they're still trying to get in range.
It's the first time we've been in that range in a long, long time.
Yeah. So if everyone just goes and quits their jobs, we will have great mortgage rates. No, that's not how that works. Don't take that.
Don't take that advice because then they're not going to qualify.
Yeah. So there you go. It's a balance.
So what we're doing right now is we're talking about normal, natural economic conditions, right? Something that's a little bit more predictable, a little bit more understandable for people that really understand it, when getting away from the chaos of COVID and the mortgage rates that were artificially pushed down with government throwing their money into the mortgage-backed securities. I mean, so since all that stopped, the conversation that we're having feels a little bit more normal conditions, right? That are affected by normal economic conditions. So having said that, we're about to get the nuclear bomb of a presidential election in the middle of all that. So how do you expect that chaos to play out? I mean, I know you don't know what's going to happen, but you've been through these presidential election cycles. What does it do these years coming up to it?
Usually the cycle right before the election and stuff, we will see a downtrend in mortgage rates. Okay,
because every president wants everything to look better, so they do everything they can.
It doesn't matter if it's a Republican president, a Democratic president. They want to make things.
They understand at that moment what makes people feel better and do better, and then they forget it afterwards.
Exactly.
Right?
Hey, it made it feel real good. Everything's going great. Rates went down half a point, 3/4 point. Everybody started, hey, we're on the right track, and so that's just generally what happens.
But no significant changes is usually the case because they also want to be able to boast about a good stock market too, right? So
there's not going to be anything significant, but you normally are going to see a slight reduction in rates.
Yeah.
Trever, one of the stats that people have always used historically, and I don't know if we haven't done it as much lately because of all the chaos that I kind of described, but one of the historical stats people used was mortgage application starts, right? And so is that something we're getting back to? Are we looking at that number again? And what is that number?
Yeah, they always kind of do look at that number and stuff. Mortgage applications, I mean, it depends on when you want to look at it. If you want to look at it, from year to year or from month to month and stuff. Mortgage applications right now are slightly higher than they were a couple months ago and stuff, but historically for year over year and stuff, we're way down.
Yeah. So we're still in a down market, but it seems like things are trending up. People are starting to feel a little bit more, confident in making a purchase, making a move, but not quite enough, not to normal levels. Is that pretty accurate?
That is accurate, and I think it's more along the lines of maybe not the confidence level as getting over the shock of them, seeing. 2-something% interest rates and 3%, and then all of a sudden we jumped up to 7%. They're still not over the shock in there.
You think so? You think that's?
I still do think that's primarily what it comes down to, and I think we're getting to a point where people realize rates are never going back down to 3% again, and then I can promise you that's not going to happen. So they're starting to realize, hey, now is a good time to buy because it is more of a buyer's market. and I can refinance later when these rates come down, which is the smart way to go about it. Because as soon as these rates do come down, up 1% or so, these home prices are going to go way up, and you're going to end up costing yourself a whole lot more money than having that higher interest rate for a year.
Investors are generally ahead of that curve, right? That's the goal to be.
Yep.
So are you seeing investor loan origination increase?
They are. The investors are there for a while. They weren't in the game and stuff, and a lot of the investors are starting to get back in the game and starting to, pick properties up and stuff again.
Because they're starting to get deals.
Yep.
Right?
And private money is starting to get closer to conventional because they want to get ahead of they need to be ahead of the curve of the Fed's rate going down too. So
it reminds me how creative the real estate industry is when our interest rates went way up and they immediately coined the phrase that everyone started using, marry the house, not the rate.
Yep.
Right? And so when you say that, it was amazing to me how quickly, that caught on. It's like, wow. It's kind of brilliant, but that is what you want, right? You want to find the house, and you're in an environment where you don't have to compete like we did for the previous 3 years, right? Compete with everybody and pay over asking. So go find the house that you really want. Don't worry so much about the rate because that can change later. Maybe we should talk about that a little bit, right? Like, what does it take? What does it cost for somebody if they decide? Because I'm sitting here thinking, when you tell people that interest rates are going down, that causes people to maybe wait and say, okay, well, I'll just wait till they come down more. That's not always exactly what you should do, because when it comes down, the price is going to go up. So what does it look like to somebody that bites the bullet and says, okay, I'll go ahead and buy now? What is it going to look like down the road when I want to do that?
So,
refinance?
There's no exact numbers on this and stuff, but I have looked at it a lot. Like you were saying, we're not in a market where we were a couple of years ago where, I don't know, John, you were seeing, maybe 10, 15, 20 offers on the same home, correct? And people are going crazy and offering, okay, I'll give 40,000 more, I'll give 50,000 more, So when you start putting that into an equation, when you're looking at right now, someone going out and say buy a $400,000 home. Okay, right now you can pick that home up for $400,000, and let's say your interest rate is 6.75%. Okay, the difference in that 1% interest rate, on that, yes, it's a pretty big chunk. Probably about $300 a month difference in if you're saying, hey, I'm going to wait because that home's going to cost me $300 more a month, okay, for a year. Okay, well, that's $3,600, okay? So $3,600 for 1 year of paying the higher interest rate, or we wait, like John was saying, we wait because, hey, rates are going to come down and then we'll buy then. Well, that $400,000 home, when all of a sudden we throw in everybody back in the market and now they're trying to buy, guess what? That $400,000 home is probably going to be $430,000, $440,000, $450,000. So, way I look at it, and way everyone should kind of look at that, wouldn't you rather pay that extra $3,600 in higher interest?
Kyle's a good example. I'd like him to explain his example. I'm sitting here thinking of all the pent-up buyers out there. Kyle's a pent-up buyer.
Well, I am. Before I get into that, the other, leading off Trevor's point, the problem I've also told people is once all the buyers flood back into the market and the prices go back to going up, if rates keep going down, you may miss out on the opportunity to refinance for that rate. Because if you wait till it's 450 in Trevor's example, and then rates keep going down another 2 points over the next year, well, if prices went up, then you won't be able to refinance. Yeah. So
that's a great point.
Or if the prices go down, you may not qualify for it. Yeah. So you're stuck in a 7 while rates are at 5. That's going to hurt a lot worse than being stuck in a 7 while your ability to get 5 is there. But yeah, to your point, my example is a little bit different than some of the fears people have had of selling a 3% mortgage to go move on to a 7% mortgage. I don't even look at it that way. I look at it as I can't wait to rent out my 3% mortgaged property for a good cash flow on the rental that will more than cover the additional expense of the interest rate.
Yeah, no, I think you're a good example of where a lot of people are in life, in making their life decisions, in their housing decisions, regardless of their interest rate right now. There's a lot of people on the sidelines. How long you been looking for your next home now? Since your son was born, at least, right? So probably about a year you've been looking for your next home, and there's just not a lot out there on the market. So
yeah, everybody's sitting on the good inventory,
yeah.
right? So once they all come back, we're back into a frenzy because there's a lot of people like me where it's like, all right, well, I don't want one of these houses people are just trying to get out of, the ones that do pop up that are quality and maybe people are moving out of the area, or they don't have the choice to wait. They need to get out for some reason. Those things are still getting snatched up in 2 seconds, and everything else is sitting there for a long time. Yep. So I get to see it because I'm looking at, I'm more browsing homes right now. So
you're the window shopper.
Yeah, I'm window shopping until the next kid's actually born. Then the pace kind of picks up, right? So, but no, I mean, if it popped up tomorrow, I'd jump on it. So. I think I still have a text from my wife with a listing in it, so you never know when the day might come. But that's how I've bought all my houses, is keeping an eye on the market, or what's available, and then jumping on deals. So.
Yeah, but we don't talk about that anymore. We don't talk about how much pent up demand there is. I mean, I bet Trever knows more than anybody because he's talking to people. They're calling him and they're asking him for advice. When should I do this? When should I not? And it's not just the people looking to buy, right? A lot of those people have something to sell. So all the move-up buyers or move-on buyers that would have happened over the last, 2 years haven't moved.
Yep.
All that stuff is pent up, and we haven't even gone into the Gen Zs, and then the next generation is the millennials, and the what's the generation after that called? I don't even remember anymore. I can't even keep track of it all. But they're all sitting there waiting to buy their first and second homes, right? And it's just, people don't realize how much pent-up demand there is in the market. To the point you were making, everyone stopped talking about that. So when interest rates go down, everyone thinks that we're just going to get back to normal. I'm not so sure that we're not going to have another frenzy.
Yeah, we're going to have another frenzy, I think, like you said. We've had this pent up, demand and stuff for 2 years, and once that happens, it's going to flood the market again, and home prices are going to shoot up through the roof.
Well, and a big concern I've heard is the math behind what if home prices keep going down. And what we're describing, all this pent up demand, is partial proof that that's not really going to happen. People, as things go down, people are going to buy them up. But we don't have a crystal ball, but you got to look at, what's the worst case if you do wait. If you do wait and things go up, then you have it at a higher price. If you do wait and they go down a little bit, you just got to wait a little longer. So probably at lower rates. So I've heard that one a lot too. People are worried about it going down, but I think we're probably bottoming out. If not now, by next summer, we will definitely be bottoming out. If they really do 3 or 4 rate drops into next year, then we're going to be looking
at that point in time. You're not going to. As soon as rates start coming down, home prices are going to go up.
Yeah,
and
especially in our area,
I think we're within 6 months of all that happening.
Yeah. And I mean, this is a huge part of the elections, right? It's all math, right? No matter which side of the aisle you're on, you let millions of people flood into your country, they need places to live, right? We're already in an inventory problem, so that will have an effect on prices. It already has, and that's why the election years have such a play on the market, is it can go many different ways. So.
What does all this mean to investors then? Trever, can you give some insight to investors that are looking to invest or continue growing their portfolio?
Well, yes, definitely on the investor side, there's a lot of new private money coming in that, like Kyle was talking about before, doing these DSCR loans and stuff, and these private money groups and stuff are getting really, really, aggressive with what they're doing. And so a lot of the investors are starting to buy and stuff again right now. And to our point, right now it is a good time, I think, because I think we're almost at the bottom of what home prices are doing. Okay. And again, as soon as these rates do come down, these are not going to be as attractive for investors because these home prices are going to go up. Again, investors, and most of them understand and get it. Let's get this property now, and we'll refinance when rates come down again.
It's buying season right now.
Yeah,
isn't it?
When you're, well, yeah, buying season's almost over, but back to the point of what is it going to cost me, to do this, to refinance, your property. If you're not talking about your taxes and insurance rolling in escrow accounts and stuff, refinancing a property generally is going to cost you $3,000 to $4,000. So paying $3,000 or $4,000 to refinance a
Add
year
that to your
or two down,
3,600.
yeah, I mean,
So now it costs you 6 or 7 to buy it now versus
an extra 20, 30, 40, 50 grand
Yeah.
in home price. So, most savvy investors already understand that, or it's just a matter of, running the numbers to it of, yeah, that totally makes sense. Okay, it's going to cost me, 6, 7 grand, over the course of a year or two or whatever to buy this property now. Well, what's this property going to be worth in, 2 years?
Yep.
How much more am I going to have to pay for this property?
Yep.
So.
$500,000, you're looking at $5,000 for every point, right? So it can pay for itself over whatever time horizon you really need, because it's definitely not a year when you're talking about long-term investing. Excuse me.
Well, I don't know. I mean, shoot, I don't. Do you have anything else to update us? Is there anything else going on? I mean, we talked
No,
last time you were here. We talked about a bunch of alternative programs. Are people still using those, or they?
Right now, I mean, it has kind of fluctuated and stuff. Government loans, FHA, VA is always attractive for veterans and stuff. It's a great loan program with no mortgage insurance, and stuff. So that has never gone away. But a couple years ago, the way this market was, FHA had lost a lot of the threshold, with the business out there. Partially doing because they had 20 different offers.
They were
and
overinvested too, weren't they? Weren't they
Yeah,
worried about being over?
Yeah, they were, but that wasn't really the reason why they lost some market share. Mainly, I think it was because
the market conditions.
These sellers had 20 different offers, and then so if a conventional offer was willing to pay them the same as an FHA, they were going with conventional.
Yep.
It's starting to shift a little bit right now because FHA's rates are about 3/4 of a point better, So there's a lot of times where I have people that can qualify for conventional and only wanting to put a minimum down payment, even though they're locked in and have mortgage insurance, on FHA, which they would on conventional too, but FHA's mortgage insurance doesn't go away. I'm recommending them with a small down payment to go FHA. Okay, because their interest rate is lower, they're out of pocket less money, and we're going to be refinancing this anyway. So the only time that really gets into a conversation of, hey, does FHA or conventional, which one's smarter to do? If you're putting more than 10% down, then conventional is going to be a smarter play because the mortgage insurance will go away, and the mortgage insurance at that point in time is might be a little bit cheaper than what FHA charges. But if we're looking at minimum down payments, FHA is a very good loan product for a lot of people right now.
And the ARM loans we talked about last time, those aren't really.
No, the ARM loans haven't come back really at all because the banks know, and who sets these, that everyone's going to be refinancing, within the next year or two, for them. So for them to offer you a much lower rate on a 3-year ARM, they're not going to do it because
it doesn't make sense.
It doesn't make sense for them.
Yeah, they might as well get bonds at that point.
Yeah, exactly. Yep.
So I have a question that is somewhat new, and I know the answer, but I'm going to ask for everybody else. As the real estate agent commission structure has changed recently, has there been any talk of those things being rolled into loans, which I already know lender, and closing costs has never been rolled in. So, but it is a question I've been hearing.
Well, no, I think no. Your question is what does everyone else perceive it? That's the question, because the real answer is it hasn't changed at all, actually. But what is the perception that other people have? Then how is it changing the conversation you're having with people?
I guess that's a better way to. Are you starting to get asked or having to change qualifications based on are you paying a buyer's commission or not?
I've only run into that one time.
Yeah.
So like John was saying, nothing has really changed,
Yeah.
and I don't foresee. And Texas has always done a little bit better job than the rest of the country at this. Okay, so here in Texas, anyway, what I know, and I don't think we're going to see a change whatsoever at all about it.
Yeah.
For the most part. I have been asked that question. Hey, if they go find this house and they're not paying the commissions and stuff, can we finance that? And the answer to that is no. Okay.
Yeah.
We can't finance those fees into the loan on top of, and I mean, unless, it all matters on loan to value. FHA is 96.5%. So guess what? If they're getting it for a whole lot cheaper and we have room, then yes, we can finance 96.5%. But the answer to that question, yes, there's been talks about whether, these banks and stuff will consider if that ever became a problem on financing that. I don't think the answer to that is yes.
Because that's kind of always how it's been in Texas. It's always really been negotiable, and seller concessions have been a thing when you can meet it with the appraised value. So, I was more just curious if you're getting that a lot, but just one time is.
The only thing that's changed for me is now that we can't advertise what we're offering, I just get phone calls constantly from agents.
Yeah.
What's the buyer's agent commission? I mean, they've just made it harder for us to communicate what we're ultimately going to communicate anyways.
Yeah.
And so, I don't know. That's the only change I've seen. More phone calls.
More phone calls.
More unnecessary phone calls that could have been handled, by reading it on the MLS. But whatever. That's what our government wanted.
They're here to make things more efficient. That's what government
No,
does.
they're not. They're just here to make it harder on us.
I couldn't think of a better joke. So, government efficiency is a good standard one.
Is that a thing?
I don't think so.
What do they call that? An oxymoron?
Yeah,
right?
those two words don't normally get put together. So they're efficient at spending money.
That's the definition of oxymoron. I love it.
Or printing it anyway. So, all right. Well, I think that's a good mortgage update. I appreciate you coming in and talking to us, Trevor. What rate would I get today on August 13th, 2024?
For an investor.
So I can ask you next time for a 20% down investor conventional mortgage, because that's what most of our.
You're going to be looking at right at about 7.5% right now.
7.5%. Even if I have an 850 credit score that none of them have.
That's correct.
Are you going to remember that next time?
None of them
I'm just
have.
kidding. I have an 852, didn't you know? All right. Well, thank you all for tuning in. If you have any questions for us or Trevor, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Trevor,
There you go.
Trevor, how do they get a hold of you?
You can reach me at 972-822-7408 or shoot me an email at Trever, Trever.Kerr
I tried.
at gatewayloan.com.
You want to try that again since I messed it all up?
No, it's Trever.Kerr at gatewayloan.com. You can spell it however you want and it'll still get there.
It's a lot easier than our name, huh? So, Thanks for coming in, Trevor. Thank you all for tuning in, and we are out.
Thank you, Trevor.
Appreciate you guys.